Following up till this point, it's been evident that the S&P 500 has shown astronomical growth and has become extremely expensive. This growth is majorly fueled by speculation around the magnificent 7 companies of the stock market and the hype around AI. Now, this again is a point of debate depending if you are growth investor or a value investor. To put things in perspective, we are currently looking at PE ratio of around 36, and that is double what the historical average has been. And this translates into the investors that are trying to buy in to the market right now are willing to pay 35 times the earnings of the stock market just to own it. Looking back right after the mortgage crises back in 2009, the investors were only willing to pay 14 times the earnings of the stock market. Now, it's a fair argument to be made that historical averages don't really apply to modern time, but still having a look at the PE ratio, it seems reasonably obvious that 35 is still pretty high. Getting to the major question, if you are someone who is a passive investor who just buys index funds, is it a wise idea to be putting a lot of money into the market when it's clearly quite high? Or is it better to reduce the amount of money you're regularly investing, or even stop until the market normalizes a little bit? Well, that's what we're gonna cover in this video. And in order to answer those questions, we're gonna turn to Mr. Jack Bogle, the grandfather of value investing. He is also the founder of the famous Vanguard group. He tops the list of one of the greatest investors of all time. It shouldn't come as a surprise, but he is clearly responsible for more wealth generation around the world than any other investor. Sadly, he passed away in 2019. But although out his career, he's been a huge advocate of simply tracking the market. Back in 1997, as the stock market was forming into one of its biggest ever bubble, Jack gave a speech on investing during an overvalued market, where he clearly mentioned that while speculation drives stock returns in the short run, it's the crystal clear lesson of history that in the long run, fundamentals drive the returns. The magnificent 7 that have risen to incredibly high valuations based on a future promise that they will be able to perform, and we are unsure that they will eventuate. Nvidia alone happens to be trading at 62 alone. And as mentioned previously by Jack Bogle, that it's always the fundamentals that drives the result. It's evident that if Nvidia is not able to produce results as high as its evaluation, then its stock price would come to a due correction in no time, spilling a lot of blood on the streets while it does so. What we possibly think that many investors would agree with Jack's statement, considering today's condition that the market is pricing in the best of the times, and only the best of the times. Now, if someone who is an active and a passive investor at the same time, when it comes to usual strategy of dollar cost averaging into the market, it just does not feel right to many to put in a lot of your own money into your long-term investments, when you kind of know in the back of your mind that the market is already pretty expensive. It feels like paying a full price for your favorite video game right before Black Friday, and you know a sale will likely come along in a few days or weeks. This begs 2 questions. Should we actually be buying our market tracking ETFs when the market is at all-time highs? And secondly, should we try to time the market just a little bit in the case? Turning back to Jack Bogle, he clearly advises one should not be timing the market, remarking that you should not at all deviate from your passive investment strategy just because certain market conditions have changed. In the similar manner, you wouldn't sell your investments if all of a sudden the market fell by 30%. As Warren Buffett likes to say, our favorite holding period is forever. The more one starts to mess around with their market tracking investments, the higher the probability is that you will lose. Truth is, the more you choose to alter your investments and trade often higher, the probability is that you may miss out on major gains. The initial idea put forward by Jack Bogle was the idea of dollar cost averaging into low-cost index funds that tracks S&P, and they are consistently buying them and holding it for a long period of time. And never selling has proven to be an exceptionally proven strategy in the past history. The average S&P 500 return has been close to 10%. That's way higher, considering what you may get elsewhere in, say, savings accounts, precious metals, and bonds. The dollar cost averaging strategy in itself works flawlessly in order to avoid such situations of extreme market valuations and volatility, yet allowing the investor to remain consistent and still be invested in the markets. Assuming that the market crashes and the ETF shares you looking to buy are now $100 each, and given that you decide to put down $1,000, you are still buying 10 shares. But what if the market goes on a boom run and the ETF shares soon worth $200? And so now that the market is expensive, you are only gonna buy 5 shares. And so this strategy works flawlessly. It's much more important to stay in the habit of constantly investing, just showing up, rain, hail, or shine. And as professed by Jack Bogle himself, passive investors are just better off if they just keep going without messing with their strategy. Moving on. It is still important to understand that having the right plan for yourself is essential even when you are buying into the markets consistently. Having hard numbers is essential. Knowing what your current savings rate is, what percentage of your income are you willing to put away, how much of that money you'll need to save for each fortnight, and how frequently are you going to invest that money. It is essential to come up with a plan that works for you specifically to be able to execute the strategy successfully over a long period of time. It's essential to understand that how comfortable you are having your money at stake. If you're someone who frequently stress about their investments and has a tendency to make snap decisions, then maybe stock market isn't for you at all. You might prefer having government bonds or other fixed income assets instead. While investing, an investor's worst enemy are not market fluctuations, but instead they themselves. You should be able to come up with money you are comfortable putting aside. And you wouldn't have to touch it for decades to come. You must invest often, and you must not be tempted in order to mess around with your portfolio. Conditionally, if you are relatively young, if you are investing the money you don't need, and you are properly spread across the market through something like a market tracking index fund, then you can be reasonably confident, as Jack Bogle says, that you bought right in the first place. So that's how you need to look at index funds when markets at all-time high. A big thanks to all of you who sticked around up till here. Please leave a like if you found this video helpful at all. Leave a comment down below. We would love to hear from you, and we will see you in the next one.